Hello students, welcome to the lecture on cash flow and funds flow statements. After this lecture, you will be able to learn the following objectives. The basic financial statement, that is the balance sheet and profit and loss account or income statement of business, reveal the net effect of the various transactions on the operational and financial position of the company. These statements do not show as to how have the funds been earned and used during the accounting period. Another statement has to be prepared to show the change in the assets and liabilities from the end of one period of the time to the end of another period of time. Funds flow statement is a modern technique of analyzing financial statement. Fund flow statement shows as to where have the funds come from and where have they been used during the accounting period. It helps in analyzing the movement of funds of a firm between the two balance sheet dates. Meaning of fund: the excess of current assets over liabilities. Meaning of flow: flow means change. When there is a change in the amount of funds, it is said to that there is a flow of funds. The funds flow statement is a statement which shows the movement of funds and is a report of the financial operations of the business undertaking. In simple words, it is a statement of sources and application of funds. Statement of cash flows. A cash flow statement is a document prepared by a company that details how much money is flowing in and out of the business. Specifically, it shows the change in cash and cash equivalents in a given period of time. Along with an income statement, most small businesses prepare a cash flow statement at least every quarter. Some may even prepare one every month. The statement of cash flows contains information about the flows of cash into and out of a company. In particular, it shows the extent of those activities that generate and use cash. This statement comprises part of the financial statements, though its importance has historically been considered less than the income statement and balance sheet. The primary activities listed in the statement of cash flows are: operating activities are an entity's primary revenue producing activities. Examples of operating activities are cash receipts from the sale of goods as well as from royalties and commissions, amounts received or paid to settle lawsuits, fines, payments to employees and suppliers, and cash payments to lenders for interest. Investing activities involve the acquisition and disposal of long-term assets. Examples of investing activities are cash receipts from the sale of property, the sale of debt or equity instruments of other entities, and repayment of loans made to other entities. Financing activities are those activities resulting in alterations to the amount of contributed equity and the entity's borrowings. Examples of financing activities include cash receipts from the sale of the entity's own equity instruments or from issuing debt, proceeds received from derivative instruments, as well as cash payments to buy back shares, pay dividends, and to pay off outstanding debt. The statement of cash flows also incorporates the concept of cash and cash equivalents. You can use the direct method or the indirect method to present the statement of cash flows. The direct method presents the specific cash flows associated with items that affect cash flow. Cash collected from customers, interest and dividends received, cash paid to employees, cash paid to suppliers, interest paid, Income taxes paid. Where is cash and non-cash transactions? A cash flow statement and non-cash transaction encompasses any aspect that undergoes depreciation or amortization. These includes transactions such as the conversion of bonds to other types of assets or vice versa, lease agreements that lead to a purchase such as commercial real estate rentals, and the exchange of any asset for another asset that is not cash. Items such as interest rate payments are not non-cash transactions. Although non-cash transactions do not normally appear on a cash flow statement, an accountant can adjust a cash flow statement to factor in such transactions. The indirect method of cash flow statement preparation. The indirect method computes the end of year cash flow by adding up net income and rule items. The accountant obtains net income from the company's income statement. Rule items include all non-cash transactions.
A cash flow statement shows the cash position of a company. Basically, it tells investors and stakeholders how much cash went in and out of the company in a given period of time. The cash flow statement is broken into 3 sections: cash from operations, cash from investing, and cash from financing. Here's Amanda. Amanda is the founder of Yogu, a successful fitness clothing shop. Amanda wants to make sure she has enough cash to pay her bills, so she begins to compile a simple cash flow statement for the past year. First, Amanda starts to record all her cash from operations. These are all the inflows and outflows, receipts and payments that go along with running the business. She records items like cash receipts from customers, cash paid to suppliers, and the tax paid over the year. She adds up the totals and records a profit of $60,000 from operations. Next, she records cash flows from investing activities. When companies buy equipment or property, it is considered an investment. Amanda sold a couple of old cash registers for $5,000 and replaced them with fancy new ones for $20,000. So, she records $5,000 inflow and a $20,000 outflow. Lastly, Amanda needs to input her cash flow from financing activities. Last year, in order to stock up on inventory, Amanda borrowed $50,000. She records this as debt. Amanda also paid a $40,000 dividend to her shareholders. She adds up net cash flows from operations, investing, and financing, and records a net increase in cash of $55,000 for 2012. There's one thing left for Amanda to do to finish off her cash flow statement. She inputs the cash balance from the start of 2012 and adds that to her net increase. So, at the end of 2012, Yogu's cash balance is $65,000. A cash flow statement is not a complete picture of a company. It ignores payments and receipts made on credit, outstanding loans, and more. However, it is a very useful tool for shareholders and managers to understand the actual cash position of a company.
Preparations of cash flow statement and its analysis. Cash flow analysis is a method of analyzing the financing, investing, and operating activities of a company. The primary goal of cash flow analysis is to identify in a timely manner cash flow problems as well as cash flow opportunities. The cash flow statement. Cash flow statements facilitate decision making by providing a basis for judgments concerning the profitability, financial condition, and financial management of a company. While historical cash flow statements facilitate the systematic evaluation of past cash flows, projected cash flow statements provide insights regarding future cash flows. Projected cash flow statements are typically developed using historical cash flow data modified for anticipated changes in price, volume, interest, rates, and so on. To enhance evaluation, a properly prepared cash flow statement distinguishes between recurring and non-recurring cash flows. For example, collection of cash from customers is a recurring activity in the normal course of operations, whereas collections of cash proceeds from secured bank loans is typically not considered a recurring activity. Cash budget. In contrast to cash flow statements, cash budgets provide much more timely information regarding cash inflows and outflows. For example, whereas cash flow statements are often prepared on a monthly, quarterly, or annual basis, cash budgets are often prepared on a daily, weekly, or monthly basis. While cash budgets are primarily concerned with operational issues, there may be strategic issues that need to be considered before preparing the cash budget. For example, predetermined cash amounts may be earmarked for the acquisition of certain investments or capital assets, or for the liquidation of certain indebtedness. Free cash flow is defined as net cash flow from operations less the following three items: cash used by essential investing activities, example, replacement of critical capital assets, scheduled repayments of debt, normal dividend payments. Ratio analysis. In addition to cash flow statements and cash budgets, ratio analysis can also be employed as an effective cash flow analysis technique. Ratios often provide insights regarding the relationship of two numbers. Example, net cash provided from operations versus capital expenditures that would not be readily apparent from the mere inspection of the individual numerator or denominator. While ratio analysis may be used in conjunction with the cash flow statement and or the cash budget, ratio analysis is often used as a standalone attention directing or monitoring technique. Additional benefits. Dick Levin suggests the following benefits that stem from cash forecasting, that is, preparing a projected cash flow statement or cash budget. Knowing what the cash position of the company is and what it is likely to be avoids embarrassment. A firm that understands its cash position can borrow exactly what it needs and no more, thereby minimizing interest, or, if applicable, the firm can invest its idle cash. Walking into the bank with a cash flow analysis impresses loan officers. Cash flow analysis deters surprises by enabling proactive cash flow strategies. Cash flow analysis ensures that a company does not have to bounce a check before it realizes it needs to borrow money to cover expenses. In contrast, if the cash flow analysis indicates that a loan will be needed several months from now, the firm can turn down the first two offers of terms and have time for further negotiations. Funds flow statement. The funds flow statement is the earlier version of the statement of cash flows that is now required to report changes in an entity's cash flows during an accounting period. The funds flow statement was required under GAAP from the period 1971 through 1987. The funds flow statement primarily reported changes in an entity's net working capital position between the beginning and end of an accounting period. Cash flow statement, direct method. The direct method of presenting the statement of cash flows presents the specific cash flows associated with items that affect cash flow. Items typically affecting cash flow include cash collected from customers, interest and dividends received, cash paid to employees, cash paid to suppliers, interest paid, income taxes paid. The advantages of the direct method over the indirect method is that it reveals operating cash receipts and payments. Cash flow statement, indirect method. Under the indirect method of presenting the statement of cash flows, the presentation begins with net income or loss, with subsequent additions to or deductions from that amount for non-cash revenue and expense items, resulting in net cash provided by operating activities. How to prepare a cash flow statement? The most commonly used format for the statement of cash flows is called the indirect method. The general layout of an indirect method statement of cash flows is shown along with an explanation of the source of the information in the statement. A less commonly used format for the statement of cash flows is the direct method.
In this video, we will see how to prepare a statement of cash flows. A statement of cash flows provides financial information about the cash receipts and cash payments of a business for a specific period of time. The statement of cash flows reports the cash effects of a company's operating, investing, and financing activities. In addition, it shows the net increase or decrease in cash during the period and the amount of cash at the end of the period. Operating activities involve putting the resources of the business into action to generate a profit. These include cash receipts from sales of goods or the performance of services, and cash payments to suppliers and employees for acquisitions of inventory and expenses. Investing activities involve acquiring the resources necessary to run the business. Resources owned by a business are called assets. Investing activities include making and collecting loans and acquiring and disposing of investments and productive, long-lived assets. Financing activities involve collecting the necessary funds to support the business. These include obtaining cash from creditors and repaying the amounts borrowed, and obtaining capital from owners and providing them with a return on and a return of their investment. Let us now look at an illustration to see how a statement of cash flows is prepared. The information about Elite Corporation for the year ended December 31st, 2014 has been provided. We are required to prepare the 2014 Statement of Cash Flows for Elite Corporation. To calculate cash flows from operating activities, we will deduct cash paid to suppliers for goods and services from cash received from customers. Cash received from customers is $90,000 and a total of $25,000 was paid to suppliers. By deducting $25,000 from $90,000, net cash provided by operating activities is $65,000. Next, we will calculate cash flows from investing activities. Investing activities involve acquiring the resources necessary to run the business. The only investing activity listed is cash paid for property and equipment. This will be shown as an outflow of $35,000. Thus, net cash used by investing activities is $35,000. We will now prepare the financing activities section of the statement of cash flows. For Elite Corporation, the financing activities are issuance of long-term debt, repurchase of common stock, and dividends paid. Cash received from issuance of long-term debt of $37,000 will appear as an inflow. Cash paid for repurchase of common stock is $44,000 and will be shown as an outflow. Cash paid for dividends is $12,000 and will appear as a deduction under the financing activities section. By deducting $44,000 and $12,000 from $37,000, net cash used by financing activities is $19,000. By deducting $35,000 and $19,000 from $65,000, net increase in cash during the period is $11,000. Cash balance as of January 1st, 2014 was $18,000. Thus, cash at the end of the period will be $29,000. The company reported $65,000 cash from operating activities and spent $35,000 to invest in new property and equipment. Its cash from operating activities was sufficient to finance its investing activities. The company supplemented the cash from operating activities by issuing long-term debt. It used excess cash to repurchase stock and pay dividends. In total, it generated more cash from operating activities than it paid for investing and financing activities, resulting in a net increase in cash for 2014.
Concept of gross and net working capital. Working capital of a company is one of the most important measures in any financial statement that is also easy to calculate. It is a reflection of the current financial condition of a company. Working capital refers to its financial health and is calculated by subtracting its current liabilities from its current assets. Gross working capital. Gross working capital refers to the amount which the company has invested into the current assets. Current asset includes cash, stock, debtors, or anything which can be converted into cash within a year. Net working capital. Net working capital refers to the difference between the current assets and current liabilities of the company. Current asset, as explained above, will be same, and current liabilities include trade creditors, bills payable, outstanding expenses, or any debt which company has to pay within a year. Preparations of funds flow statement. Fund flow statement is prepared and interpreted on the basis of net working capital concept. Funds flow statement measures and presents in an analytical manner the summarized version of the numerous flows of funds for a specific period. Fund transactions. There is a plenty of business transactions which result in flow of funds or which cause changes in working capital. For this purpose, all the business transactions are classified into A. Those transactions which increase funds, that is, sources of funds. B. Those transactions which decrease funds, that is, application of funds. The following transactions do not affect the flow of funds. Transactions between two current assets, transaction between two current liabilities, transactions between current assets and current liabilities, transactions between two non-current or fixed assets, transaction between two long-term liabilities, transactions between non-current assets and long-term liabilities. As against this concept, any transaction between a current account and a non-current account affect funds. These are transaction between a long-term liability and a current asset, transaction between a long-term liability and a current liability, transaction between a non-current asset and a current asset, transaction between a non-current asset and a current liability. Importance of funds flow statement. The following are the benefits of funds flow statement. It provides a detailed analysis and understanding of changes between two balance sheet dates. It shows the fund mobilization and canalization. It helps to take fund projections for the future. It is a useful technique to measure the quantum funds needed for efficient operation of a firm. Preparation of funds flow statement and its analysis. The preparation of fund flow statement has the following steps. Schedule of changes in working capital. It can be prepared by comparing the current assets and current liability of two periods. Rules for preparing the schedule. An increase in current assets results in increase in working capital. Decrease in current assets result in decrease in working capital. Increase in a current liability results in decrease of working capital. Decrease in a current liabilities results in increase in working capital. Advantages and disadvantages of cash flow statement. The cash flow statement has several advantages, which are: work as management tool to assess the liquidity of an organization, helps employees to assess the overall viability of their employer, help investors to evaluate the future growth potential of an organization, helps stockholders to know if the organization is generating enough cash to pay dividends, helps creditors to know if their customers would be able to pay credit, help financial institutions in equating the borrowing capacity of an organization. Disadvantages are: consumes a lot of time as the preparation of cash flow statement requires a thorough and complete understanding of different activities of the organization. Requires proper skills to understand and analyze the information revealed. Lack authenticity if the incorrect data is used to prepare cash flow statements. Provide scope for the manipulation of financial data to misguide the investor and government. Now in the end, let us summarize what we have learnt in this lecture. Summary.